All right, class, we're into chapter number 9. So in this chapter and the next, we're going to be dealing with partnership taxation. And before taking a look at the detailed slides, let's kind of review the accounting for a partnership, specifically the partnership interests. And if you haven't taken yet the advanced financial accounting class, this is probably where you're going to learn accounting for a partnership. Usually in an introductory accounting class and maybe intermediate financial, you would learn the accounting for a corporation. And we've already covered the taxation for corporations in the past chapter. So here's something all of us should be familiar with. We know that the assets of an organization are equal to its liabilities plus the owner's equity. But in the case of a corporation, we saw things in the equity like stock, additional paid-in capital, retained earnings, and probably embedded in this section is also the revenue and expenses that get closed out into retained earnings. And maybe then the dividends are also declared and distributed from the retained earnings or equity section. But in the case of a partnership, we don't have stock, and the earnings are going to be divided up among the partners and not kept in a retained earnings account. So what we're going to do is set up a partner, let's call this partner number 1 capital account. And then we need at least 2 partners, probably more, but here we have at least 2, one capital account for each partner. And we need to know of course the balance in each of these 2 partner capital accounts, and it'll go up and down probably during the year, but then we need to take a report, a balance, and prepare financial statements with whatever is in these accounts at the end of the year. So we know the equity is probably going to be the total of the partner's capital. The equity is equal to the assets minus the liabilities. But that is not necessarily what is the partner's basis in their partnership interest. In other words, whatever is showing here in the capital account for partner number 1 is not necessarily equal to the adjusted cost basis of his or her interest in the partnership. The chapter number 9 here, we talk about including part of the liabilities to be added into each partner's capital account. So let's say we have 2 equal partners here, and all of these liabilities are shared equally among the partners. So what we would do is take part of the liabilities here and add it to the partner's interests, and the rest of the liabilities here and add it to the other partner's interests. So when we figure out what is the partner's basis in the partnership, in his or her partnership interest, we have to take into account all of the liabilities and that partner's basis. Yeah, that partner's share of the liabilities and the partner's basis equals to that partner's basis in his or her partnership interests. And that kind of makes sense because what we are really doing is allocating all of the assets which can generate costs or expenses or losses among all the partners. We're assuming though that each of these partners are personally liable for their share of the liabilities. So now they can share in the cost of the assets over here. But again, what you're looking at in a partnership accounting records is just the equity allocated to each partner and not the additional cost basis increased by their share of the liability. We're also going to see that if the liabilities go up or down during the year, that'll have an effect on the cost basis going up or down over here. Because again, the cost basis is equal to part of their share of the liabilities. And definitely another thing that will affect the partner's interest is if they contribute more into the partnership. This partnership interest will increase. the partner contributes cash, the partner contributes assets into the um, partnership. Their share of the equity here will also increase. Now, if the partnership withdraws cash, yeah, reducing assets, we know we got to stay in balance here in the accounting equation. That's going to reduce the equity, reduce that basis of the partnership's interest. Other things that will increase or decrease the partnership interest is the amount of income or loss shared among the partners. So we know, let's say this is the revenue of the partnership minus the deductions equals the net income or loss of the partnership. And we learn here in chapter 9 that the partnership does not pay any taxes on its profits, but that profit or net income or loss has to be allocated among the partners. So again, in the case of a corporation, that profit or loss was updating the retained earnings account. Well, here we're going to be updating the partner's capital account for their share of the net income, or reducing their capital account by their share of the net loss. Keeping in mind, whatever is in their capital account is what they can withdraw out of the partnership tax-free. And if they withdraw out more than that amount from the partnership, any excess would be a gain they would have to report, probably a capital gain. Also, if the partner sells his or her interests to someone else, maybe even redeeming it back to the partnership, they're not going to report a gain on everything they receive, but they can deduct whatever cost basis is left, the so-called outside basis, including their share of the liabilities. Okay, so that's kind of an overall view of accounting for a partnership's partner's interest in a partnership. Let's take a look at more detail. So in the case of certain types of business entities, the entity doesn't pay any income tax, but the income and expenses will flow through the business to the owners. In other words, a partnership is a flow-through or pass-through entity. It doesn't pay any taxes on its profits, but that income or loss is now allocated to its owners, the partners, and now the partners will pay taxes on that income. Other types of flow-through entities we'll see in a future chapter is a so-called S corporation. What we've learned for corporate taxation in past chapters was a C-type corporation, where that type of corporation does pay income taxes. An S corporation, just like a partnership we're learning here, with some modifications, will have its income or loss flow through to their S corporation shareholders. Another type of entity would be, let's say, a trust or estate. Okay, they may pay taxes, but many times they would allocate the income to the beneficiaries of the trust or the estate. Most small businesses are now run through limited liability companies, which is generally treated as a partnership. So again, there would be pass-through entities. Again, the main thing here is that pass-through entities like a partnership do not pay taxes. They still have to file information returns, which we'll see in the second video, the next video, but generally they don't pay taxes like a C-type corporation. Let's kind of look at the that flow-through concept. So here is our partnership, and it receives revenue and it pays out expenses or deductions, and it gets a net income or a net loss. And of course, in the case of individuals like you and me, or C-type corporations, we would pay income taxes on that net income, taxes to the federal government, income taxes to the state government. But in the case of a partnership, this information here would be reported on a Form 1065, an information return, not a tax return, because you don't pay taxes with this form. And there's supplementary schedules, one called a Schedule K. Maybe this is something you're going to be working on in your second project, that allocates or groups the income and deductions in certain categories. And now this income and deductions are going to be allocated to the partners. Let's have two partners again, partner number 1 and partner number 2, and to communicate to them their share of the partnership's income, deductions, credits, and so forth, all totaled up here on Schedule K. The partnership would also have supplementary Schedule K1s. So here would be one K1 going to partner 1, reporting his or her share of the partnership's income and deductions and credits, and another K1 going to partnership number 2 for his or her share. Now when the partners prepare their return, let's here have a 1040 form for the partner. There's going to be supplemental schedules or forms attached to the 1040. One of them being a Schedule E that would report the partner's main income on that form. The K1 may have other types of income reported elsewhere in the 1040 form, but the main type we'll see is first reported on a Schedule E. Then there's a new Schedule 1 that kind of summarizes all of this miscellaneous income, then reported back on the 1040 form group with more common type of income. Okay, so again, the partnership here doesn't pay any income taxes, even though we have to file a tax return over here, a 1065. It's the partners up here that pay taxes. Keeping in mind also that this income that's being reported here is not necessarily the amount of cash they received during the year. Cash received during the year is called drawings or withdrawals, and generally drawings or withdrawals are tax-free to the extent the partner has a cost basis. They're recovering just the cost basis tax-free. But once they recover more than that, any distributions from the partnership would be taxable. So that's why it's important to know what is the cost basis of each partner's interest in their partnership interest. So let's start off by creating a new partnership. So if you remember that accounting equation, if you start off a partnership, there is no assets and you don't owe any money right now, and the partner's interest is 0. So that's no way to run a business. So you got to have some assets in there. So we're asking our partners to contribute definitely cash. So we have working capital. And if you already have a business being contributed into the partnership that will continue the business, that old business probably has other types of property, be it equipment, a building, automobiles, or intangible assets, copyrights, patents, contracts. Services are not necessarily considered to be property. Okay? So all of that property is here going into the partnership as assets, crediting the partners here who are contributing that property. So now each partner has partnership rights, a partnership interest. But saying that a partner has a partnership interest doesn't necessarily mean how much they're going to be able to collect when the company is profitable, or how much of the loss they will be allocated. Losses are good now, yeah, because we get to deduct it, reducing the partner's taxes. Profits, not good for tax purposes because you pay taxes on it, but definitely you want profits because that's how you make money. and eventually also when the partnership will liquidate, how much is that partner going to collect? All of this is determined under the partnership rights, and we have to determine that up front when we form the partnership. So in the case of how much the partner will get when they liquidate, we call that a capital interest. That may not necessarily be equal to whatever is the balance in that partner's capital account. Also, when the partnership is running, how much of the profits will that partner get credited for? Or if there's losses, how much are we going to be charging them for the losses? All of that has to be determined up front. The partnership interest, the loss interest, partnership interest in profits, the partnership interest in losses, the partnership interest in the capital assets or the liquidation value may not necessarily be the same amount for each partner. It could vary. And it's up to the partners to determine how much they would share of each of these items among themselves. And as long as there's a business purpose to have a certain percentage or dollar amount assigned, the IRS will pretty much agree to that allocation. Again, business purpose, yeah? I believe the term is called substantial economic effect. And saving taxes and giving away stuff to your family is not a business purpose, okay, in the eyes of the IRS. So when you contribute property to the partnership, the general rule is that there's not going to be any recognized gain or loss. You would have a realized gain or loss. Remember the difference between realized and recognized that we learned a few chapters ago? Generally, gains are not recognized. They are postponed or deferred until the underlying partnership interest is disposed of, or the underlying asset that was contributed is disposed of by the partnership. This is kind of similar, not quite exactly the same, when we had formed a corporation a couple chapters ago. So if you remember section 351, the tax-free formation of a corporation, the comparable section for partnerships is section 721, where again there's no gain or loss generally when you contribute property into forming a new business, be it a corporation or a partnership. Now there's of course always exceptions to the general rule. So if you remember under 351, one of the exceptions was when the shareholder takes back boot, or when a assumed mortgage is greater than the basis of the underlying property. That kind of doesn't apply to partnerships, although if the assumed mortgage in a partnership contribution assumed by the partnership is greater than that partner's basis in the partnership interest, not the basis in the property contributed now, but the basis in the partnership interest, the liability is greater than that, only then is their gain recognized by that partner. And the reason why, and we'll see it in an example a few slides from now, is that a partner's interest, the balance in the partner's basis, cannot go below zero, cannot go negative. That's also including any liabilities that would increase the partner's basis. That basis amount cannot go negative. So just to bring it up from negative to zero, that partner would have to report gain, and gains allocated or income allocated to partner will increase the basis, in this case up to zero. So again, the general rule is that neither the partnership or the partners will recognize any gain, even though gain may be realized. So if there is a loss, like if the cost basis of an item is bigger than the value, maybe what the partner wants to do is sell the asset and recognize the loss individually, assuming it's a capital asset or a Section 1231 business asset. That partner would be able to recognize, deduct the loss, and then with the proceeds contribute that to the partnership. And now the partnership can use that to buy whatever it needs. In the case of an unrealized gain, you don't want to sell it, right? The partner doesn't want to pay taxes on that gain. And that's what Section 721 will help with. In the case of services by themselves, again, this is not property. So by saying I'm going to work for my partnership, that doesn't give you any basis. It's only when you get allocated income that will increase the basis of that partner's interest. So this kind of reemphasizes if the contributed value of the property is bigger than the owner's basis, the partner's basis, that's going to be tax-free, an unrealized gain. Sometimes they call it built-in gain, because built in, when the partnership sells it, they're going to have to report this gain. And if the value is less than the partner's basis, here's a situation where you want the partner to sell the asset before they contribute it. And again, if it's a capital asset or 1231 asset, they'll be able to report and deduct that loss on their individual return. So again, we're starting up a new business. So initially, that partner's basis is going to equal to whatever cash they contributed. The main reason here is because $1 of cash has a cost basis of $1, has the same basis as its face value. Whereas other property, the cost basis is usually what they bought it for, reduced by any depreciation, and it may not be the same as its value, right? But to keep things equal or proportionate among partners, at least in financial accounting, what they focus on is possibly the value of what each partner is contributing. And they don't really focus on the underlying cost basis or tax basis that we are interested here in our class. Okay, so that's going to be the sum here equal to, I guess we call it substitute basis of the partner's interest in their partnership investment. And the cost basis of any asset contributed now to the partnership will have a carryover basis of the old cost adjusted basis of the partner. And as I mentioned in the opening slide, that we have to include in each partner's interest their share of the partnership debt. Let's see if we have an example here. Before we take a look at an example, there's different types of partnerships, like a limited partnership, limited liability partnership, and so forth. And there's also different types of debt. And all of these different types of partnerships and partners and different types of debt may affect how you allocate the debt among the partners. In the case of debt called recourse debt, recourse meaning that whoever lent the money, the creditor, can go after not just the business, but the individuals who promise also to pay back the money. In the case of a general partnership, where all the partners are general partners, they are personally liable for any debts the general partnership cannot pay off. So by definition, debts of a general partnership should be recourse debts if the partnership agrees to borrow that money and pay it off. Let's say that you're a limited partner in a limited partnership. If that limited partnership has recourse debt, you're not liable for that debt. You're only liable for whatever you invest in the partnership. Okay, so that's looking at recourse debt and different types of partnerships. Let's look at non-recourse debt. And we'll see this pop up in the second video when we talk about at-risk rules. Non-recourse debt, you're still borrowing money, but the lender is only going to go after the property that was used to buy the borrowed money. So typically we're looking at real estate, a mortgage, and if the borrower doesn't pay it back, the only thing that the lender can do is go foreclose on the property and sell it to pay back the loan. The borrowers are not liable under a non-recourse debt. Now, if I was the bank lending money, I don't want to lend money like this. I'm going to make everybody sign off as personally liable and put a mortgage and put a possible financing statement or a lien on the property if they can't pay it off. But in the case of non-recourse debt, unlike recourse debt, we're still going to allocate the debt among the partners, but according to their profit sharing ratio. So if you're sharing 50% of the profits, half of the non-recourse debt is going to be allocated to you that you can add on to your partnership basis. That doesn't mean that you can use it to claim a deduction, because again, we're going to talk about at-risk rules in the next video. So here's just a summary. In the case of recourse debt, you can use that amount to increase the cost basis to whatever partners have to pay off the debt or agree to pay off the debt contractually. Non-recourse debt, again, the general rule is only the business is liable to pay back the debt if the underlying asset cannot be used to offset the total loan. In that case, partners are still allocated their share of this debt, but according to their profit sharing ratio. So this is the rule we're going to take a look at for an example, and we'll see this same situation being applied in one of the homework problems. Yeah, so you may want to pay special attention here when you get to the homework. Here it says that when the debt is bigger than the cost basis, there's going to be gain recognized only if the debt is larger than the partner's basis in his or her partnership interest, and not bigger than the basis in the property. Okay, so that's a difference between corporations where there was boot and partnerships here where we were looking at the bigger probably cost basis of the partnership interest. In the case of holding period for the carry over of a basis to the partner, it's going to be the same holding period of the asset given up. This would apply to capital assets and to Section 1231 business assets. Probably wouldn't apply to ordinary assets. Ordinary is going to be ordinary income, be it short or long term. But we like long-term capital gains. And 1231 by definition is long-term. And the carryover basis to the partnership is going to be the same as the basis that in the hands of the partner. So we talked about contributing services, and if you're contributing services and getting a liquidation value, a capital interest, that's going to be income right away to that partner that's receiving the interest. Also though, whoever partners are giving up their capital interest to compensate this partner that's receiving the capital interest, the partners giving up the interest also have an immediate deduction. Okay, ordinary income to the receiving partner, and ordinary deduction to the other partners. If there's no capital interest, but the partner who is providing the services will only get a profit sharing interest, then there's no immediate income to that partner. It's only, let's say, at the end of the year when the partner receives their income. That's the amount they report as income. So we talked about forming a new partnership, yeah, where partners are contributing into the partnership. But let's say that you're an incoming partner where you're buying your partnership interest by buying it from an existing partner. So you're not going to really step into the cost basis of the old partner's partnership interest. Whatever you pay that existing old leaving partner, departing partner, is your new cost basis. And the partnership itself may not even know this amount. They don't see any cash being transferred among the new and old partners. But this is going to be the cost basis of the incoming partner. And you also have to pick up that new partner's share of the partnership debt like we talked about before. And the total is going to be the basis of that new partner's partnership interest. So things can be quite complicated, and a lot of times because not everything is known by the partnership. Each partner should be keeping track of his or her own partnership interests. And that's why they call that outside basis, outside of the partnership, versus inside basis, which is basically the accounting records, the balance showing up on the partner's capital account. We've seen this topic here in the case of forming a new corporation. So the same situation would be applying for forming a new partnership. There's certain costs that we incur when we start up the business, and we can deduct up to certain dollar amount, dollar limits, and the rest may have to be amortized over, let's say, 60 months. We can't do that though for syndication costs. Yeah, that just sits there on our books. Okay, I'll let you read this on your own. Let's go through an example. So the example in our textbook talks about a partnership, CCS, where we have 3 partners. So initially the partnership is forming and each partner is contributing $120,000 worth of assets to get this partnership going. One of the partners, Nicole, is not contributing all cash. She is contributing a total of $120,000 of value, but that's made up of $10,000 cash and then land worth $50,000. So total there is $160,000. But again, each person is contributing a total value of $120,000. So what we're doing here is also having the partnership assume a $40,000 mortgage, a so-called non-recourse mortgage. In other words, the bank can only go after the land to claim this balance due to the bank. So 160 minus 40 equals that 120,000 value. We're also told that in the hands of Nicole that the cost basis of the land was 20,000. Some people would think, oh, that's really should be added to the 40. The 40 is not part of the cost. Maybe 40,000 was used to buy the land. In fact, these numbers don't look too accurate here. You would think that the cost should be bigger than the mortgage, but we're just using the numbers here. Okay, so cost doesn't necessarily equal mortgage and vice versa. So the question here is asking, what is the cost basis of each of the 3 partners? We're also told there's another $60,000 of liability being borrowed by the partnership. that has to again be allocated among the partners to increase their cost basis and their partnership interests. So here's a table that summarizes the three partners. Let's focus more specifically on Nicole, the one that's contributing the land. But she's also contributing cash. Notice that the land will go in for cost basis purposes, not at the value, but her basis of 20. And then we have to add each partner's share of the liabilities. If you remember the 60,000 that the partnership has already borrowed, divided up three ways, we're allocating that among the partners equally. And then here's where it gets a little bit tricky. Remember the 40,000 mortgage? It's exceeding the cost basis of that property, this 20 up here, by another 20. So we're allocating that to Nicole, the person that contributed the land. The person that's being relieved of the 40,000. Notice down here we're allocating, we're reducing the amount she's contributing by that 40,000 that she's being relieved of. Okay, so now 40 is the total mortgage, being kept or allocated 20 to Nicole, and that's leaving another 20,000 that we have to allocate among all the partners. Again, 40 to Nicole and 20 to the other partners. So 20 divided three ways, it comes out to this 666. And if you total all the columns, you notice that the typical one is cash being paid, cash being contributed, and their share of the liability, the partnership liabilities, to get their cost basis. Nicole's is again a little bit different. It's not just the cash she assumes, but also the cost basis of other property and the amount of liabilities like the others. But this one here, the excess of the mortgage being assumed, that's this 40 down here, over her cost basis. That's this 20 up here to get her basis. And because this is bigger than 0, there is no gain on this assumption of this 40,000. Now if her basis goes below 0, goes negative, then this amount of relief is going to be taxable, and you're going to have another number added here, the gain she has to report to bring her negative balance up to 0. So I believe that's the next assumption here. We're told that Nicole is not going to assume any of the liabilities, even any of the 40 that she's being relieved of. Here's the 60 that the partnership had borrowed initially, and here's the 40 that the partnership is assuming when they take over the land. So 100,000 of loan, and Nicole is not assuming anything of it. So you're not going to allocate any of that to her basis. So here is again her basis in the property she's contributing. Here is the land, cash she's contributing. So total of 30 she's contributing. But she's being relieved of 40,000 of debt, and that's going to leave her negative 10,000. And we're told that you cannot have a negative basis in your partnership interest. So we artificially going to increase it from negative 10,000 to 0 by having her recognize gain of 10,000. She has to report this gain of 10,000 on her tax return, individual tax return, and pay taxes on it, just to bring her basis up to 0. Again, anytime at the end of the year, if it goes below 0, you know there's going to be at least that amount of income being reported by that partner, in addition to anything else flowing through to the partner. So we have here another example where a partner is contributing services, and in exchange they're going to get a liquidation value, a capital interest. In this case, it's a liquidation value of 20,000 going to partner Sarah for the work she's doing. Sometimes they call this a guaranteed payment, when you're giving a partner an artificial salary or a specific dollar amount of income being assigned. And we'll talk about that in the second video. The other factors here don't come into play in determining how much she has to report as income. So here is the amount Sarah has to report just on this allocation of a capital interest she's getting for the additional work she's doing. But the other partners have to reduce their capital interest, and the way we do that is allowing them to deduct their share of the amount they're giving up. Okay. So Sarah is going to report ordinary business income of 20,000 just for this transaction, and the other two partners going to report ordinary business deductions of their share. Okay, so to equalize that. Now again, if this partner is only going to receive a profit sharing interest in the partnership and not a liquidating or capital interest, there would be nothing here, nothing to report, except at the end of the year how much profits allocated to that partner. Couple more items here for this first video. So when the partnership first begins, the partnership can elect the type of accounting method they're going to use. And again, we've seen this when we had covered corporations. The main thing here is whether it's going to be cash basis or accrual basis. We already talked about expensing that startup costs, organization costs, syndication costs, and making an election to deduct it or to amortize it. Elections to deduct property costs. This is really that bonus depreciation, and for 2018, I guess 2019, it's 100% bonus up to certain limits. Or if you remember that section 179 deduction, again up to certain dollar limits. Well, bonus is really you elect out if you don't want it, and section 179 you elect in if you want it. Okay, and here we're told that these elections are made on the partnership tax return and not on the individual partners' tax returns. Now there may be limits applying to partners individually, but the initial election to start everything is made at the partnership level. So the general rule is if you have an average of less than 5 million of gross receipts during the year, sales, fees, then you can go cash basis, even though you keep track of your billing under accrual basis. Yeah, for tax purposes you can stay cash basis if you average under 5 million a year. So when can you pick your year? What period of time? So for most businesses, definitely individuals, they would use a calendar year. I've never seen an individual not use a calendar year, January 1st through December 31st. But it's possible partnerships can use a different year end. So let's say here is our partner's year, January 1st through December 31st. And let's say the partnership starts up their business 1 month into the calendar year on February 1st. And they can pick any year end up to the end of any month. They don't have to choose this one as the same as maybe you and I, December 31st, as long as the year is not more than 12 months. So from February 1st through January 31st, that's 12 months. Now the thinking here is that, see, all of this profit here really is allocated to year one. and should be taxed in year one. But by just choosing to have a year end for the partnership 1 month later, all of this profit for 12 months is going to be reported here on January 31st. In year two, the partner will report his or her share of the partnership income in the year in which the partnership year ends. So all of this 12 months of income reported right here in the second year. And we actually are deferring 11 months worth of income. So because of that potential, let's say, abuse, the rules require the partnership to adopt a year end similar to the majority partners. So here, I guess, is the rule, yeah? So if there's a majority interest and they have the same year, like all of the partners are individuals, that pretty much tells you the partnership also has to have a year end of December 31st. It's usually when you have partners who are corporate partners that don't have a December 31st year end. Then you have to start either looking at who are the main partners. Principal partners are partners that have more than a 5% interest. So pretty much you're ignoring real small partners. And if those principal partners have the same year end, then you got to adopt that for the partnership. Otherwise, you got to go through this formula called least aggregate deferral, which is kind of illustrated in our textbook and kind of complex, so I don't want to go through that. But for most partnerships, definitely those owned by individual partners, they're going to have a calendar year end. Let's stop here and go ahead and take a look at the next video where we talk about allocating income into something called ordinary and separately stated.